Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, May 21st. You're tuned into On Trend. So I'm going to show you why I think we're in some sort of correction consolidation mode and why it could last. We'll see that small caps are leading lower. We'll update the mean reversion bounce. I'll show you a checklist to use for trend and leadership. And we got some stocks to watch. All right, so we're going to set the tone with a weekly chart for the S&P 500 SPDR SPY. And if you notice, I've got an underscore just before that symbol, and that means I'm using unadjusted data, which does not include dividends in the case of SPY. And so that means it's going to look more like the S&P 500 chart, because the S&P 500 does not include dividends either. You can chart the S&P 500 total return index if you want to see dividends, or you can just remove the underscore on SPY if you want to see what it looks like for dividends. But if we look at this chart here, we can see a market that was, really trending nicely since that breakout in the middle of 2016, had a little pullback, and then, 2070 was really a gravy year. And then we had kind of this blow off top there into early 2018. And then the market dynamics changed. We went into a more volatile market. You can see we've got these big swings here. This is a double-digit decline. This is a double-digit advance that was bigger than the previous decline. And then we had this big decline in October and into December, very sharp. But we've had an even sharper advance to a new high. So the fact that we're making higher highs and higher lows over the past 18 months tells you that the market is a bit out of control. Now the question is it more bullish than bearish? And I think that answer right now is yes, at least as far as SPY and large caps are concerned. And the simple reason is, 52-week high is bullish there, and we did get one. So that's +1 for the bulls. You can see we're just above the rising 40-week moving average. That is bullish. This is kind of a resistance zone that we're above. That's also bullish. And you can see that the PPO 440 is positive, and that's the 4-week EMA, the 4-week EMA less the 40-week EMA. And so when the 4-week is above, it's positive. When the 4-week is below, it's negative. And you can see that it has been positive since the early part of February there. And so as long as it remains positive and we're above that 40-week moving average, I think the bias is bullish. But if we do break down here, then we could see further weakness. But, I'm not going to call for a crash, and I'm not going to call for a move to the lower trend line. I would just turn bearish on the market and forget about a target, because targets rarely, especially broad market targets like this, they are rarely, if ever, fulfilled. And I think also you got to consider that if you look at the advance, like I'm going to go to the inspect button just to show you these swings that we've had. So there's the first swing. So I click and hold down on that click, and then I drag to the low. And if you look over to the left on this chart, you can see it was about a 12% decline. And so I click again on the low, and I drag up to that high in September. And you can see it's a 16% advance if you follow that top blue line to the far left. And then if you click on that high and you drag to the low, you can see on the left it's about a 21% decline. And then up from here, we've had about a 27% advance. So these are some big swings in the last 18 months. And you can see we're back below the highs from January 2018. So we pretty much have gone nowhere since January 2018, which is 69 weeks. Now, we had a couple of bearish breath events, as I will call them, in May, but I don't have a medium to long-term bearish breath signal, so to speak. But we do have a couple of short-term signals. And, short-term signals are kind of difficult because on the one hand, they show you that you're oversold, but on the other hand, it shows strong selling pressure or broad-based decline where a lot of stocks participated, and that is negative. So the indicator here is AD percent, advanced decline percent. And I've got an example at the top left here. So if you have 450 advancers out of 500, that's 90%. If you have 50 decliners out of 500, that's 10%. So 90 minus 10% is 80%. That would be plus 80%. So if you have 450 decliners, that's minus 90%. And you have 50 advancers, that would be 10%. So you would get a minus 80% down day. And you can see for all three of these indexes, we had a minus 80% down day and 80% in early May. And so that was kind of like the catalyst that started this corrective process that we're currently in. And we got another one about a week later. And so that continued the corrective process. And I think we need to get a surge above plus 80% in at least two of the three to suggest that this corrective process is over. So as you saw in that weekly chart, there's plenty of room for the index to simply meander for a couple of months, and that would be perfectly normal after a big advance. So here's what we got so far. We've got the out of control market as seen by that broadening formation or megaphone with the higher highs and lower lows. We've had a 26.7% advance in SPY in a relatively short period of time, so we're due for some sort of a correction. We had those two big down days in 80% with a triple minus 80% reading, so that was for large caps, mid caps, and small caps. And then you put those three negatives or signals that suggest we're getting into a corrective mode, and then you look at seasonality. All right, I'm on the free charts page, and there you can see seasonality chart, and you go to the S&P 500 here, and I'm going to go ahead and resize this chart so it fits in the window there, and I'll move this window a little bit, and then I'm going to expand this out to 20 years. And what we can see here is, and I've showed this before, and I don't use seasonality by itself, but if you use it in conjunction with what we're seeing on the price charts, and I'll look at small caps in a minute here, you can see that this is the weakest 4-month stretch of the market. And June is one of the weakest months overall in the market. If you look at the average advanced decline for June, it's a decline of 1%, and June closes higher 53% of the time. So this does not argue well for strength heading into June. So given the evidence here, it suggests that we could be into a corrective range-bound period for the S&P 500. We can also see that the number of downtrends number of strong downtrends is increasing, and we can see that with the expansion of new lows yesterday. So I've got the high-low pairs for the S&P 500, S&P Mid-Cap 400, and S&P Small-Cap 600. There you can see the symbol, exclamation point, new high SPX, exclamation point, new low SPX. And in order to chart those as an up-down pair, if you go down to the indicators, you can select up-down pair as an indicator. And so that's what I've done, price up-down pair. And then you enter one symbol, comma, and so I've entered new highs, comma, and then I entered the symbol for new lows. And I did that for all three. And so I can see new highs and new lows very easily. And what we're noticing here is we hit 24 new lows in the mid-cap, S&P mid-cap 400, and that is the most new lows since December. And we hit 38 new lows in the S&P small-cap 600, and that again is the most new lows since December. So we are seeing an increase in new lows, especially in mid-caps and small caps. We can also see this when we look at the percentage of stocks above the 200-day EMA for the S&P 500, 56.4%. For the S&P Mid-Cap 400, it's below 50% at 46%. So that means 54% of stocks are below their 200-day EMA. And for the small cap S&P 600, 40% of stocks are above the 200-day EMA, which means 60% are below. So this is by far the weakest index of the three, and you can see that percentage above the 200-day EMA moved below 40% there in the latter part of March. So that was the bearish signal, and it remains active until it moves above that 60% threshold. Now, I don't use the bullish percent indexes very often, but I'll go ahead and show this chart. The bullish percent index is basically the percentage of stocks within the index that are on a P&F buy signal, which is basically a double top breakout on the P&F charts. So if you're not on a P&F buy signal, that means you're on a P&F sell signal. So if you're below 50% for the bullish percent index, that means more stocks are on P&F sell signals. Now, I've got this indicator for the S&P 500. You can see it's $BP SPX. And then I've got it for the New York Composite, $BP NYA, for the S&P 100, for the NASDAQ 100, and the NASDAQ Composite. And there you can see the numbers there. Less than 50% of NASDAQ Composite stocks are on a P&F buy signal. Only 51% of NASDAQ 100 stocks are on a P&F buy signal. And 59% of S&P 500 stocks are on a P&F buy signal. So if you look here, you can see that in October, we started going below 50%, first there in the NASDAQ Composite, which is purple, then in the NASDAQ 100, which is green, and then the New York Composite, which is blue, and then the red is the S&P 500. So when you get these, the majority below 50%, then you've got some trouble brewing possibly in the market. And the way I created this chart was I used something called price same scale as an overlay. So there you can see the overlays, and price same scale is an option. So that means all the indicators or symbols that you put on there will be on the scale of the main indicator, which is the bullish percent index for the S&P 500. So I did that for all four, and I put a horizontal line in at 50 because that's kind of like the make or break point for this indicator. But I think the key takeaway is we have the NASDAQ 100 and the NASDAQ Composite leading on the way down here in April and May. And they were leading there in March and early April, so they've turned into the laggards, and that's a negative. So I outlined a mean reversion setup last week, and it's based on two things. It's based on 5-period RSI, which you can see in the first indicator window, and the percentage of stocks above the 20-day EMA, which is in the lower window. So basically, when you have a decline and you have RSI go below 30, you're oversold short term, and you get a move above 30, then you're getting a bounce. And you can see we had a second dip below 30, and we had another bounce on the 14th of May. And the percentage of stocks above the 200-day moved below 30 and then above 30 on the 14th. And so that green line shows when you got that signal there. And so, if you'd taken an entry the next open, you'd still be positive, but you would probably need to put a stop loss just below that open there and ensure that trade doesn't turn into a loser. Now, as far as whether you do an intraday or end of day, that is a fielder's choice. All right. Me personally, I'm an end of day kind of guy, but it's totally up to you whether you want intraday or end of day. But we can see here we've got a move. We're starting to retrace it a little bit. And so if we go, we close below that low from 4 days ago, that would be quite negative. And I also view the close below 285 as negative personally, because this bounce should have held. That gap up 3 days ago did not hold, and that's a negative. Now, if we look at QQQ, we can see where the weakness in the market came. So we basically got a signal a day later in QQQ on May 15th when RSI moved above 30 and the percentage of stocks above the 20-day EMA and the NASDAQ 100 moved above 30. So you got a signal up here around 183-ish, and then you've gapped down. So that's no good. And now you're right at this make or break level here. So, if you go below this low from 4 days ago, that would clearly negate the signal there. And then if we look at IWM, it has failed as well. You can see you got the signal on the 14th. And so you would have gotten a good entry on the next day, the 15th, and a little bounce, but you can see you gave it up. And so when you give something up, you have to reevaluate. So if you're a close-only player, then, a close below yesterday's low would definitely do the trick. But I think it's failed because we've had a double dip there back below 30 in RSI and the percentage of stocks above the 20-day EMA. In addition, small caps are seriously lagging, as I'm going to show here in a minute. So I want to go over a little checklist for uptrends and market leadership. And I'm going to use RSP, the S&P 500 equal weight ETF, as my benchmark here. And you can see I'm using unadjusted RSP with a underscore just below the symbol there. So it doesn't include dividends. So it'll look just like the S&P 500 equal weight index. And you can see there's the high from October. And we did not make it above that high. That's a benchmark high. So anything that made it above that high is showing some relative chart strength in a way. We also have benchmark highs here in late or early November and early December. And stocks that made it above those highs and are still above are showing some sort of relative strength as well. And then we have a benchmark low. And this is a low in March. Sometimes it's in late March there. But if you're above that low, you're holding up all right because some stocks have already broken below that low. And so these are kind of the highs and lows that I'm using when I'm comparing other charts. And you can also compare RSI levels. For instance, you can see RSI did not make it above 70 in April, and it's already moved below its prior low. It didn't go below 30, but RSI wasn't up to snuff there in April. So how does that compare to, say, another chart? Well, let's look at SPY on a daily chart. So I've got the benchmark highs there, and you can see SPY is holding up better than RSP, the equal weight version. So we did just get above that high, and we fell back. And we are still above, just above this high here, and we're above that benchmark low. And you can see we had a higher high in RSI in April, whereas RSP had a lower high in RSI. And both of them held above 30 on the recent decline. So SPY is a little bit stronger than RSP. Now, the real differences come when we start looking at small caps. So if you look at the Russell 2000 ETF, we can see that it did not come close to this high here from August, September, that benchmark high. And it did break above that October-November high, but it didn't hold above. It's back below it. Now, it hasn't broken below this low yet, so that's about the only thing it's got going for it. And you can even compare 200-day moving averages. You can see this 200-day moving average is falling, and IWM is below it. All right, whereas RSP and SPY, they're above their 200-day moving averages. So not a lot of positives here for IWM. Another negative I should mention is the bearish failure swing in RSI. Now keep in mind that this bearish failure swing is independent of a bearish divergence, even though we also have a bearish divergence on the chart. Now the bearish failure swing was developed by Wells Wilder, and he of course is the creator of RSI, and he introduced it in his book, New Concepts in Technical Trading Systems. And I believe that was the early 60s. So there are four parts to this signal. First, you become overbought with a move above 70. Second, you have a dip in RSI. Third, you have a bounce in RSI. And this is important, it fails to get above 70. That is the failure. All right. And then the confirmation comes when you move below the prior low, which we did last week. So we have an active RSI failure swing in IWM. And we also had one here in early October. So I'm not predicting another crash. I'm not predicting this sharp of a decline. I'm just saying that signal is there. Small caps are lagging. You see it in the breadth indicators as well. So it's just not the place to be right now in the small cap universe. Now you might also notice that there's a divergence here. I personally don't use divergences, but there you can see the close here and a close there in early May, a higher high based on the closes. And then you can see the lower high in RSI. So that is a bearish divergence in momentum. Now, using these benchmark highs and benchmark lows, you can also compare, say, two stocks, or you know where the benchmark highs and lows are for the S&P 500 and SPY. And so that kind of gives you an idea of what to look for. And if we look at Cerner here, it's really come alive over the last few weeks. Now we can see this 52-week high here with that new move higher in May. So it is above the summer high there. And you can see Pfizer, was doing well in late November, but right now it's well below that high. So it's not near a 52-week high. Here are the highs from late December and March. And you can see similar highs in Cerner. And then Cerner broke above them with that big move in April, whereas Pfizer did not. And then you can see a benchmark low in March that Cerner held above when Pfizer broke down. So, a lot of pharmaceuticals were breaking down here, and Cerner was going the other way, and it just continued. So also you look at the 200-day, even though the 200-day for Pfizer is rising, it's below the 200-day, and Cerner is well above the 200-day, and it's just turned up. So you can see that Cerner clearly has a stronger chart than Pfizer. We can do the same thing for Adobe and Apple, and since they're both kind of tech stocks, we can draw up the lines here. First, I'll draw that benchmark low there from February, March. You can see it for Apple. So they're both doing well there. I'm going to draw the high here from the high in October for both of them, and I'll color it red. Let me move that up so you can see it. And we kind of had a benchmark high here as well that Adobe cleared. We can mark that high right there in November for Apple. And so now we can compare these two charts, see how they compare. Now, sometimes it isn't crystal clear. In the case of this one, it is right now who is the leader. And remember, you do have a choice. The institutions have a choice. And the institutions are clearly more in favor of Adobe than Apple. So you can see there's that high in October, and Apple never got close to it. All right, it's still well below that high in May, whereas Adobe was making new highs. So it was leading there already. And there you can see it broke above that late November high in February, and Apple was still well below that high, and it didn't break above it till March, so it was outperforming. Adobe was back above its 200-day in early February, and Apple didn't get above until March. And then you can see Apple is below its 200-day now, and Adobe is above. So clearly Adobe is the winner here if you have to pick between these two stocks just based on relative performance of the charts. It has a stronger uptrend, and it has stronger momentum than Apple. So now we've got some stocks to watch. These are stocks in uptrends looking for a continuation higher. Boston Scientific hit a new 52-week high there in February and March. Had a pullback below the 200-day, but is back above, and the 200-day is rising. So I think the bigger trend is up. More importantly, you can see we're getting a breakout after this correction here. Got to move above that high, just above it. And so it looks like Boston Scientific wants to continue higher, can reevaluate on a close below that May low. Looking at FISV, it is holding up quite well within the technology group. There we can see kind of a resistance zone turning into a support zone, if you will, here. So we had a big move up, a 52-week high, and it looks like we're correcting after that 52-week high. These trend lines don't match up, but the essence is there. It's a big advance. It's a correction. We're surging off support, and FISV is one of the leaders right now. So I would expect a breakout and move higher. Here on this chart, we can see it's an IPO. So there's the IPO in October around 20, and it's above 70 now. But we can see, clear progressions higher, breakout, and a new high, and then a pullback, finding support in that 60 area. And then we got a couple of breakouts here, and we're on the verge of another one. Now you can see it's near 80, and the next support is in the low 60s, maybe the gap around 70. So it's clearly a high risk play. Next up is Insight Pharmaceuticals. Now this one is interesting because you have this resistance zone that turns into a big support zone. So we had the big move up, and we had a pretty sizable decline, but back into this breakout zone. So there's a lot of resistance here that turns into support. We firmed for a couple days and then broke out there with this big surge here, but we come right back down. And now we're firming again. So I'm watching for a continuation off this support zone for Insight. Closes below 73, can reevaluate on that one. Next up is Lilly, and it was hit with the rest of the pharmaceutical group there in April, but it did manage to find support above the rising 200-day moving average. And you can see this big consolidation zone here would act as support as well. I'm sure if you put a volume by price indicator here, there would be long bars around this 110 area. So we got a rising 200-day moving average. We're firming. Got a little bounce 3 days ago, so I'm watching for a continuation higher for Lilly. Next up is Merck, and Merck is holding up pretty well. It held this support zone here in that 70-72 area, had a pretty sharp decline, but bounced, recovered real good. You can see there's a little bit of a flag working there. I'll redraw that with a straight line. So there's a little bit of a flag wedge, and we're breaking out of that flag wedge for Merck, and I think it's holding up quite well considering. Next up is Tractor Supply, and it did hit a 52-week high there in April. So you can see the break above this resistance zone here and a bit of an inverse head and shoulders. And so that broken resistance turns into support. And so we've got a throwback to this support zone. So this is the first area to watch for a bounce. And you can see we got a little bit of a flag or a wedge pattern forming there. I'll go ahead and redraw that for you. There it is. And so there is resistance turning into support. And so we're getting a bounce, and it looks like we're poised to break out and continue the uptrend for Tractor Supply. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.